Well, hi everyone, Shaun Humphries here. Welcome to All Things Retirement. Well, in this video, I'm going to talk about a really important subject, and that subject is, okay, we're going to get our statements soon. At the time of this video, statements will be generated for year-end results for 2022, and it's really important that we fortify ourselves before we look at our statements. So if you look at your statements in September of 22, they didn't look great. They're not going to look any better for the end of the year. So it's against that backdrop with so much negative noise and news and information out there, it gets more and more difficult to act with investment discipline. So I'm going to share some information with you that I think you'll find helpful that will fortify your investment resilience so that you can make some really good financial decisions for 2023. So I think you'll find this video helpful. Now, if you're new to our channel, make sure you hit the subscribe button. We're posting content all the time on various aspects of retirement and overall wealth planning. So hit subscribe if you don't want to miss future content. And if you like the video, make sure you click like. Okay, let's talk about the year that was and what could be in 2023 and how we can fortify ourselves to make great investment decisions in this coming year. So what I've done is I've put together a few slides just to illustrate some of the important points that I want to cover off in this discussion. So the first slide, basically we're going to look at a capital markets discussion really focused on 2023. Are there reasons to be optimistic, cautiously optimistic, so that we can really act with discipline? Because the longer this volatility or sideways market goes, the higher the probability is that investors will bail on what could very well be a good strategy. It's just the timing of the strategy hasn't worked out for you over the last year. So we're going to talk about last year, and because last year is a setup for this year, and so it's going to have some major impacts in terms of how capital markets react and how your portfolio will react to that market. So the first thing we need to remind ourselves on is, we had to digest very significant headwinds this past year. A lot of this had to do with coming out of COVID policy. COVID policy had profound impacts. It may or may not have been the best policy in terms of dealing with a pandemic. I think the jury's out on that. It's a controversial topic sometimes in some corners. But there's no denying that the policies themselves had a very disruptive impact on the global economy and capital markets. So supply chains, as an example, were basically disrupted in a major way. The labor market was essentially destroyed in many ways, and so we're recovering from that. Central bank support, which was very significant through the last 3 years, keeping interest rates low is one example, while rates are going higher, and so it's creating some economic dislocation. Reduced government support. So we went from massive fiscal and government support spending, tax breaks, to now a withdrawal of that support, and it has an impact on the economy. I'd say incoherent policies, a patchwork of policies in different areas, whether it's in health, whether it's in economics, fiscal programs, made things difficult and continue to make things challenging. Massive government spending, which was maybe necessary through COVID, but it happens to be a very major driver of inflationary pressure. Because what was happening is there was the opening of economies all over the world, but those openings were in advance of capacity. You have all this pent-up demand for travel and leisure and the service sector, but we did not have the infrastructure to deal with that demand. Too much money chasing too few goods and services is almost always inflationary. Hence, the situation that we're in right now and what we experienced through 2022. And of course, the last one, geopolitical. So the tragic war in Ukraine has been this sort of hangover, this gray cloud that encompasses everything. It's not the only single factor to focus on, but obviously it's had an impact on commodity prices, energy costs, the cost of living, and inflationary pressures. So if we go back to the last few years, this is a chart that shows you the U.S. stock market, the S&P 500, and this is 5 years. And you can see that if you had invested 5 years ago in the U.S. market, you still have very satisfying returns over that time period. However, there's been obviously volatility. This particular area here represents the market meltdown in March of 2020 when COVID became a reality. But there was unified response by central banks and governments, and we saw the market recover very quickly from that point on. Well, we get into 2022, and we've seen this up and down movement around capital markets as they've struggled to really deal with each of these items I've just talked about in the previous slide. So this is the setup for 2023. As the market and the economy has had to digest all these headwinds what could we expect over this next year? I'm going to talk about some of the main themes. It's not perfect by any stretch of the imagination, but there are some reasons to be cautiously optimistic or really optimistic in some circumstances about capital markets going forward. Let's take a look at that right now. Now, the first fact that I'd point you to is that last year was unique in the sense that when the stock market went down, so did the bond market. And usually there's a bit of a inverse relationship between the two. So bonds did not help to buffer portfolios against the volatility experienced by stock markets. This chart shows you U.S. Treasury bonds, how rates were very low through COVID, and then we started seeing rates going up as central banks began to raise rates to fight inflationary pressures. So this is the long end of the bond curve, but it's a good proxy for where bond yields have been. Now, that's just the yield. The yield's gone up. There's an inverse relationship between bond prices and yield. I'm not going to go into that relationship in detail today, but this chart shows you 10-year U.S. Treasury notes and their historical price. And really all this is designed to illustrate is that the price of bonds has dropped quite a bit over this last year. And so as rates have been going up, bond prices have gone down. So we had the perfect storm in 2020 in that both stocks and bonds went down. So we're going to talk about what's going to happen with the bond market in just a few minutes. And I think it's going to be an encouraging story for you. Now, this slide I put together is designed to try to capture some of the positive and negative forces going on. So when we watch the news, it probably seems to you like there's just nothing but negative. But under the hood or under the surface, there are actually some positive things going on. So let's just summarize the positives and we'll get to the negatives. Fewer pandemic restrictions. That will be over time good for the economy globally and domestically. We believe interest rates are close to the peak and diminishing inflation pressure probably has arrived already. So we've gone through this painful exercise of increasing rates and we're probably pretty much done that increase. Supply chain problems are easing. It's not fixed completely, but if you look at used car prices, that's a good proxy for where things have gone with supply chains. Very high cost for used cars. Those prices are coming down. That's an indication that supply chains in general are getting better. We're very bullish on fixed income investments, which really struggled last year, but have the potential to do well this year. Attractive stock valuations and dividends. So typically what happens is there's two sides to the equation when stocks often move. One side is valuation levels. So often when stocks go down in value, and what's referred to as their PE multiple, which is basically a measure of value. When that multiple improves and stock prices go down, it incents capital if they're quality companies and maybe companies that are dominant in the sectors they work in. It incents capital to go back into those stocks for a good reason. If we can buy great companies at a more attractive price, it makes sense for institutional investors and retail investors to do that. The other benefit is as stock prices go down, big companies, great companies typically don't cut their dividends. So they certainly don't cut them easily. They really think twice about doing that. So if I have a company that is paying a 3% dividend and the share price goes down to by half, which that's an extreme example, but let's say it did that. Well, if I bought that same stock and if they haven't cut their dividend, if I can buy it 50% less, that dividend yield to me as a new investor is not 3%, but 6%. So that equation, dividend yields and more attractive valuations will incent capital to go into the market. Now, the other piece, though, is earnings and future earnings forecasts or momentum. So there's a very high likelihood that we're going to go into a recessionary cycle. The question is, will it be a deep recession or a mild recession? That range of recessionary predictions is going to have an impact on corporate earnings. And so that's the piece that I don't think anyone is absolutely sure about where that's going to go. We see a reset to more normalized market conditions. So what I mean by that is last year, if you look at the market, it became more and more concentrated to tech stocks. If you look at Amazon or you look at Meta, Alphabet, Microsoft, even for a while, Zoom or Peloton, all these companies, these virtual companies that really benefited from either the tech bubble that was growing over the years or COVID. And it made the market very concentrated and very difficult for portfolio managers and investors to sort of seek out opportunities because the stocks that were really growing were hypervalued, they were overvalued. And then we had a lot of sectors that kind of languished. We now have reset the table. We have a much more balanced market where there are opportunities in a lot of different sectors. And actually balanced investors, diversified investors, will likely be the winners over the next few years. We don't have to worry quite as much about this very excessive concentration of sectors that are driving most of the returns. And unlike many recessions, if we go into this next few months into a recessionary cycle, corporate balance sheets are very strong. So there's actually a lot of positives that we can latch onto. Now, the negative forces obviously are inflation's still high, but we do feel it's falling, and we've hit the peak. There's fiscal drag, so when you see higher interest rates, declining government spending, geopolitical issues that have an impact on trade and commodity prices, there's just fiscal drag and tighter financial conditions in general. So that really means that capital markets will have a more difficult time, companies more difficult time growing their earnings. And then we've got commodity shocks because of the war in Ukraine. Commodity prices generally are high. Now, that's good for some sectors. It might be good for Canada and other countries that are rich in commodities, but generally it's a bit of a constraining factor. And then monetary tightening has the Federal Reserve Board, the Bank of Canada, the European central banks, have they gotten it right in terms of raising interest rates enough to sort of stamp down inflationary pressures, but not so high that they put us into a deep recession? And I would say the consensus right now likely is we go into recession, but probably it's going to be a mild recession. So I think interest rates are a very, very significant part of the discussion on markets going into 2023. So this slide is basically saying Bank of Canada nearing its peak policy rate, and debate about rate cuts later. We just had a rate hike. The Bank of Canada seems to be messaging that we're probably close to the end, maybe the end of rate hikes. So rates have plateaued, and we think that rates will likely come down through 2023. Now, why that's important is that, again, if we go back to the relationship between interest rates and bond prices, the bond market, which was not a great place to be last year, could be a very good place to be this year. So not only will investors get a decent coupon rate, but if interest rates begin to fall, you'll see bond prices begin to rise. And so don't give up on your fixed income securities this year. I know it's been a very frustrating period for you as an investor if you hold them, but you're likely to see above average performance potentially through 2023. And so this is a very important sort of policy consideration when you look at central banks to just keep an eye on. We think rates have basically peaked or close to peaked and actually will begin to fall in 2023. That's good news for your fixed income securities. So that really summarizes the key themes that we're keeping an eye on right now. So just to summarize again, we believe that inflation is essentially pretty close to peaking, that central bank policy is pretty much done in terms of higher interest rates. We believe that interest rates will actually fall in 2023, and that has the potential to really make for a good fixed income market. So that part of your portfolio has the real probability of having decent returns this year. The stock side of the portfolio is really mixed, and it's not like the high quality blue chip stocks aren't going to do well over the next few years, but we're in a bit of a transition period. So it will be a bit of a game of patience. And what I mean by that is, on the one side, valuation levels, dividend yields are very attractive. That will tend to incent capital into that category. On the flip side, there is recessionary concerns. So likely it's going to be a mild recession. And one thing to keep in mind, a part of the market decline last year was discounting for the fact that we were probably going to an economic slowdown in 2023. So the market, to a certain extent, has already discounted the recessionary cycle we may go through. So stock prices are down partly because of that, and of course higher interest rates. So what could happen, and we see this often with markets, is when the headline news on stocks is negative, you may actually see stocks moving forward because there's already been a discounting happening on stock prices to reflect the fact that recession was anticipated. So if we get a mild recession and we have good valuation levels, and in fact, if some of the discounting has already happened on many stocks, we could come through 2023 with better returns than what people likely expect. I think going out the next 2 years, 3 years, a balanced portfolio could be a great place to be. Bond market should be reasonably strong. We should see performance gains in the stock market. And the chart that I have in front of you right now just illustrates that. This is basically the U.S. market from 1981 to 2022. The red represents some bear market cycles. What you see is the market's up over 75% of the time, down about 25% of the time. When we go through these red bear market cycles, you usually see multi-year gains in the market. So everything's cyclical. We'll likely see some of that happening. So we don't know the timing of all these things. We don't know to what degree we'll get performance out of equities over the next year, but it's not all bad news. And this certainly is not the time for you to be liquidating your positions and just bailing into GICs or guaranteed investments. Those investments could play a role, but they should not play a role right now if you're a medium to long-term investor. Balanced portfolios should have very competitive returns over the next 3 to 5 years. Well, it's my hope that you found this video helpful. And again, it's good material to fortify yourself against any negative feelings you might have when you open up your statements for year-end 2022. Now, if you don't want to miss future content, make sure you hit subscribe. If you like the video, make sure you click like. As well, if you're within 5 years of retirement, or maybe you're already retired and you'd like a second opinion or want to confirm if you're tracking in the right direction, make sure you go to our show notes. There's a link to our website, and you can find out how you can get a complimentary retirement planning analysis. Anyway, wishing you all the best in your retirement and overall wealth planning journey. You take care. Bye-bye.